Welcome. I'm Greg Duge with Foley and Lardner, and I'm pleased to welcome you to the Employee Benefits broadcast series. Joining us today are four outstanding speakers who will discuss items of interest both during the remainder of 2012 and as we enter 2013. Eric Vogt of our Chicago office will lead off with a discussion of potential consequences where a benefit is denied, either in whole or in part, and the ERISA claim and appeal procedures are not strictly followed. For many plan sponsors, the claim and appeal procedures tend to run on autopilot, something that the vendor takes care of. But Eric will explain why plan sponsors should have a keen interest in this subject. Second, Kathy Aizawa from Foley's San Francisco office will discuss a 2014 rule that actually has relevance beginning in 2013. Beginning in 2014, the healthcare reform law requires many employers to offer healthcare coverage to full-time employees. This obviously raises the definitional question of who will be considered a full-time employee. As Kathy will explain, application of the rules in 2014 may depend upon 2013 data. Finally, Sam Hoffman and Andrew Greger from our San Diego office will discuss 2012 action items, a list of year-end reminders to keep your benefit plans compliant and running smoothly. Before I turn the presentation over to Eric Vogt, I'd like to go over a few housekeeping items. Today's program will last approximately 1 hour. The PowerPoint presentation will be available on our website at foley.com. You may also click the print icon on the bottom right-hand side of your screen to print a PDF. If you experience problems with live meeting, please call 866-493-2825 for technology assistance. For audio assistance, dial star, then 0 on your telephone to reach an operator. We encourage you to submit written questions during the program. Simply click Q&A on the menu bar of your screen and type your question. We will respond to written questions and also take questions at the end of the program if time permits. To ensure that you get the most out of today's presentation, we encourage all participants to maximize the PowerPoint to full screen usage. You can do so by hitting the F5 button on your keyboard. And as a reminder, today's program is being recorded and will be available on Foley's website early next week. With that, I am very pleased to turn today's presentation over to Eric Vogt.
Thanks, Greg. As Greg mentioned, I'm going to discuss some of the potential pitfalls and consequences of failing to comply with ERISA claims procedures. This probably isn't something you think about on a regular basis. So kind of the intent of this presentation isn't to go through all the details of specifically what the requirements are. Rather, the intent is just to give you an idea of some of the risks which are associated with ignoring the claims and denial process. So I'm just going to start off with a general review of the claims process. Many of you are probably already aware of this, and this is just going to be a real quick overview. So initially, the claimant, who could be a participant beneficiary, files a claim for benefits. Then when you receive the claim is either approved or denied, and a notice is sent to the claimant. In the event they disagree with the determination, the claimant files an appeal. The appeal is approved or denied, and then he's sent the notice. There might be multiple levels of review, some mandatory, some voluntary, but that's the general explanation of the internal review process. And then once they exhaust the internal process, the claimant can file a suit under ERISA. Another thing that was added by the Patient Protection and Affordable Care Act, also known as healthcare reform or lately commonly referred to as Obamacare, is a requirement for external review for group health plans. Essentially, this is just requires an independent review organization to review the claim. Now, of course, these are just the steps in the process, and in order to ensure a meaningful review process, there are some regulations which contain minimum standards for what processes you need to follow. So there's two main sources of law which governs ERISA claims procedures. There's the DOL claims procedure regulations, and then there are some additional requirements which were added by healthcare reform. Now, the DOL regulations have a lot of requirements in them, but some of the things you think most commonly of are time frames for benefit determinations and content requirements for denial notices. These requirements were enhanced by healthcare reform for certain group health plans, and again, as I just mentioned, the requirement of external review was added. The healthcare reform only applies to group health plans, so it's not going to apply to what are called HIPAA-accepted benefits, such as limited scope vision or dental coverage, and it also doesn't apply to what's called a grandfathered health plan. We've discussed the issue of grandfathered status in prior benefit broadcasts, but just real generally, it just means your group health plan was in existence on the date that healthcare reform was adopted. There's various requirements that you need to meet, and one thing that you generally keep in mind is that design changes can result in a loss of grandfathered status. So those are the rules. Kind of the question you're probably asking yourself is how does it matter? How does it come into play? Some errors that we commonly see are if a claim denial notice fails to comply with the detailed content requirements, so it doesn't contain all the legal bells and whistles. A more serious violation might be kind of if the appeal notice doesn't tell the claimant how to file an appeal. Then obviously you have the question as to whether the claimant actually had a meaningful review process. Another common problem is that the notice is not sent within the required time periods. So, again, the question is, so what? What are the practical implications of failing to comply with these requirements? Now, there's 5 consequences that I'm going to highlight in today's presentation. Deemed exhaustion, heightened standard of review, award of substantive benefits, tolling of statute of limitations, and the imposition of an excise tax for group health plans. And I'm going to discuss each one of these in turn. So we'll start off with deemed exhaustion. The general rule is that a claimant has to exhaust the internal claims and appeals process before they can file suit. The requirement that they do exhaust this process has a lot of benefits. For example, it's going to increase the likelihood that the dispute can be resolved without litigation. If in the event you clearly make an error in your initial determination, upon an appeal, you're probably going to see that you made an error, correct the error without having to go to court and incur all the legal fees. Also, it might be that the claimant doesn't want to jump through all the hoops and they simply don't fully pursue their claim. Also, as I'm going to discuss shortly, it creates a plan decision to which a reviewing court must defer and also tends to limit a court's review to the factual record created in the plan's appeals process. However, there's an exception to this rule, which is called deemed exhaustion. That just means that you're deemed to have went through the entire internal appeals process. And so upon deemed exhaustion, a claimant can initiate external review and may pursue any legal remedies available. The rationale is that a plan failed to provide reasonable internal appeal process which could result in a decision on the merits. Now, there's 2 different standards for whether a claim is deemed exhausted. Historically, courts have applied what's called the substantial compliance standard to determine whether deemed exhaustion applies. Under this standard, technical noncompliance with ERISA will be excused if the purpose of ERISA's claims procedure requirements are satisfied. And the purpose of the claims procedure requirements is just to ensure that there's a meaningful review of a benefit denial. So in the event your plan says that you're going to respond to claims within 30 days, it takes you 31 days to respond, you're probably not going to have an issue under the substantial compliance standard. Now, with healthcare reform, a new standard was added, which was the strict compliance standard. And the original standard imposed deemed exhaustion if a plan failed to strictly adhere to all the claims and appeals requirements. Now, this raised a lot of concerns because people were asking themselves, if I responded in 31 days, is the claim deemed exhausted, and which will subject me to all the consequences that I'll discuss later in this presentation. So in response to these concerns, the DOL modified this standard and created an exception for de minimis violations. Now, de minimis violation is a violation which does not cause and is not likely to cause prejudice or harm to the claimant so long as the plan demonstrates that 1, the violation was for due cause or due to matters beyond the control of the plan, and 2, that the violation occurred in the context of an ongoing good faith exchange of information between the plan and the claimant. Now, it's important to note that this modified strict compliance standard doesn't appear to be a return to the substantial compliance standard. So for group health plans, which are subject to the Patient Protection Affordable Care Act, they are going to need to keep this more strict standard in mind. So again, stepping back, what difference does it make if the claim is deemed exhausted? You might think the worst that can happen is that the claimants are going to be able to file a suit a little early. So rather than running through the process for another couple months, they're just going to sue us. Unfortunately, that's not the only consequence. Deemed exhaustion can lead to a heightened standard of review in the event the claimant elects to file a lawsuit. So generally, when a claimant files a suit after his benefits have been denied, a court will apply what's called the arbitrary and capricious standard. And it's, generally speaking, this means that the administrator's decision will be upheld as long as it is reasonable. And the rationale for this is that if a plan document includes a grant of discretion to the plan's decision maker, the court should apply a deferential standard of review so that the decision is only overturned if it's arbitrary and capricious or an abuse of discretion. Now, this doesn't mean that your decision will never be overturned. A decision without an explanation or a decision which clearly conflicts with the plan's plan language may be found to be arbitrary and capricious. Another advantage of the general arbitrary and capricious standard of review is that a court is typically going to limit the review to the administrative record at the time the claim was decided. So there's not going to be a lot of discovery, which can be very time-consuming and costly in the context of litigation. However, this arbitrary and capricious standard may not apply in the event of deemed exhaustion. The appeals regulations provide that following a plan's failure to comply with the internal review requirements, the claim is deemed denied on review without the exercise of fiduciary discretion. So this may suggest that less deferential, what's called de novo standard of review, will apply to claims that are deemed denied. In fact, the DOL has taken the position that a reviewing court should not afford deference to a plan decision that fails to comply with the claim's regulations. Now, when a court reviews a plan's decision de novo, it's simply going to ask whether it agrees with the decision. And it does not give any deference to the decision maker, and there is no presumption of correctness. In addition, courts are generally more willing to accept additional evidence, so discovery, when conducting the de novo review. And what standard applies can actually have a very large consequence on the ultimate outcome. Some courts, in overturning denials under de novo review, have noted that the result would have been different if an arbitrary and capricious standard applied. So, taking one step back again, there's a higher risk that you can lose your case under the higher standard of review. So, you may be asking yourself, so what's the worst that can happen? They'll just remand it to the plan administrator. I'll follow the process they want me to follow. I'll deny the decision, and that'll be it. No harm, no foul. However, that's not always going to be the case. There are some instances in which courts have decided to award substantive benefits. I've noted a couple cases on the slide. There's the Wenner versus Sun Life Assurance case, which retroactively reinstated disability benefits. It involved a claim for disability benefits which were ongoing and a termination by the plan's decision maker. And the court's reasoning in reinstating benefits from the date of invalid termination was that since the initial grant of benefits had been terminated in violation of the claims and appeals regulations, the benefits were never properly revoked. Another decision is the Razanek versus AIG Life Insurance Company decision. Now, this involved a claim for AD&D benefits, which is accidental death and dismemberment benefits. in this case, the claims procedure for the plan provided that claims would be processed within 90 days. So a participant in the plan submitted a claim, and it took AIG 16 months to actually deny the claim. After disagreeing with the decision, he filed an appeal. The plan's appeals process permitted the AIG to take up to 4 months to decide this decision. After waiting 7 months, the claimant finally decided to file suit seeking a declaration that the claimant was entitled to benefits. Now, it's kind of interesting to note that AIG ultimately realized their mistake, and 1 month after the suit was filed, tried to deny the appeal, but the court kind of said too little, too late on that. And the court ultimate conclusion was to reverse and remand the case to district court for reconsideration under de novo review. Now, in declining to remand the case to the plan administrator, the court stated that under de novo review, remand to the plan administrator is an available remedy, but not always the appropriate one. So there is some risk that if you don't follow the claims procedure, a participant might be able to be awarded benefits even if they weren't actually entitled to them under the terms of your plan just because you failed to follow the procedural standards. Obviously, there's a lot of factors which are going to decide whether or not a substantive remedy is awarded. Many courts do just remand to the plan administrator. So it's going to be the facts, the arguments raised by the parties, and kind of the ultimate leanings of the judges in prior case law. However, the bottom line is, if you really screw something up in your claims procedure, it's possible that substantive benefits may be awarded. So it might cost you significant money by failing to comply with your claims procedure. You may be saying to yourself, well, that is a serious problem. I'm glad that our plan has a 2-year limitations period on claims, so I don't have to worry about old claims. We'll fix this going forward, and hopefully we won't have to worry about anything. However, another consequence of inadequate claims procedures is that the deadline to appeal and file lawsuits may be tolled. Now, the statute of limitations imposes an outside deadline by which a claim has to be filed in court. And if you fail to file a lawsuit within that limitations period, your claim is generally barred. ERISA doesn't have any specific statute of limitations. So when courts are deciding what limitation period to apply, they typically use the limitations period for a state law claim that is most similar. Now, often this is going to be a claim for a breach of contract. And this can result in very, very lengthy statute of limitation periods. For example, in Illinois, there's a 10-year statute of limitations for written contracts. One of the ways that plans try to get around the lengthy statute of limitations and state-to-state variations in statute of limitations is by imposing deadlines for filing suits. Now, both the statute of limitations and the plan-imposed deadlines generally begin to run on the date the claim for benefits is denied. However, in some instances, courts have found that inadequate notification will not trigger running of the appeals period. Now, if the appeals period never starts to run, the claimant may be able to avoid the statute of limitations. So you could have a claim, let's say you had the 2-year limit on lawsuits under your plan document, and 10 years later you had somebody that filed suit because they say you didn't adequately comply with the claims procedure. So it really has the potential to increase your liability. And actually, there's been some people that have built a business model out of this notion that the deadline is going to be told. So these organizations will go to entities which typically have a large amount of benefit claims that they submit. So often it's going to be a hospital. And they go to the hospital, they put together a presentation, and they say, listen, you have all these old claims. You're not doing anything with them. You think there's no money there, but give them to us. Let us work them. You won't have to pay us anything unless we get a recovery. So they work on what's called a contingent fee basis. And so this business model may be, although it's kind of just starting to pick up may be something that we see more often in the future, because it's possible that hospitals may just view this as free money. And so when these people review all these claims, they might go through and they'll look for the big benefit plans and say, where did they make a mistake? Look at the coding, and they'll try to find all those mistakes, and then they'll appeal all those claims or file suit on the basis that the statute of limitations period has never started to run. So this is the potential to be very expensive. And just in case the higher standard of review, substantive benefit awards, and inadequate standard of limitations don't motivate plan sponsors to comply with the DOL claims procedures, the Internal Revenue Code also imposes an excise tax for employers that fail to comply with the Patient Protection and Affordable Care Act, which also includes the claims and appeal requirements, because it, as I mentioned before, it just enhanced the claims and appeals requirements to the prior requirements under the DOL regulations continue to apply. And the amount of the excise tax can be quite significant. The failure to comply with healthcare reform can trigger an excise tax of $100 a day for each individual to whom the failure applies. Now, there are a few exceptions to this rule. First, the tax may not apply if you can demonstrate that you didn't know and in exercising reasonable diligence would not have known that there was a compliance failure. Also, the tax may not apply where the failure was based on reasonable cause rather than willful neglect, and the failure was corrected within 30 days after the person knew or should have known that the failure occurred. Now, this penalty obviously can get very, very large, but there is a cap if the failure is due to reasonable cause and not willful neglect, in which case the excise tax cannot exceed the lesser of 10% of the amount paid to provide medical care during the taxable year for group health plans, or $500,000. So either way, it can still be a big tax, even with the cap. And in the event that the penalty does apply, it's self-reported on Form 8928. So just kind of some general takeaways and summarizing what I've talked about today. Now, an employee benefit plan acting through its plan administrator is legally responsible for establishing and maintaining a claims procedure. So even if you outsource your claims and appeals process to a third-party claims administrator, as Greg mentioned, for a lot of clients, our clients, this is kind of something that's almost on autopilot. So you will still need to ensure that these third parties comply with these requirements. Practically speaking, market pressure is going to create incentives for these third parties to comply with the claims and appeals requirements. If word gets out that a claims administrator isn't following these rules and all of a sudden all their clients are getting hit with substantive benefit awards and all the other things I talked about today, they probably won't be in business for very long. But since you do have the ultimate responsibility for these procedures, it might be worth taking a look at your claims process to confirm that it's compliant with ERISA claims procedure. So just some questions you might want to ask yourself are, do our claim denial notices contain all the legally required information? Are we timely responding to claims and appeals? That kind of thing. And I realize this can be a lot of busy work for people who obviously have a very busy schedule. However, it's usually cheaper to fix something up front before it happens than waiting for something to go wrong and dealing with the litigation costs associated with that. I appreciate your time today. Feel free to give me a call if you have any questions. My contact information is at the end of the slides. I'm now going to hand over the presentation to my colleague, Kathy, who's going to discuss one of the upcoming requirements imposed by healthcare reform.
Thanks a lot, Eric. Today I'm going to give an overview of one aspect of what many people call the pay or play provisions of healthcare reform. And oftentimes it's called the health pay or play, but it's actually the shared responsibility requirements as referenced in the code. And if somebody could help me with my slides, I'd appreciate it because I'm not able to move them. This new guidance that I'm going to be discussing is actually found in IRS Notice 2012-58. Next slide, please. Thank you. So as Greg mentioned at the top of the hour, beginning in 2014, large employers are going to be subject to a non-deductible excise tax if, one, they do not offer any health plans to their full-time employees and their dependents, or two, they offer a health plan, but that plan is either not affordable or it fails to meet certain minimum requirements. Now, keep in mind that for both triggers, the excise tax applies only if a full-time employee gets his health insurance from a state exchange and qualifies for either a premium tax credit or cost-sharing assistance. So this requirement begs the question, how do I know if my plan is affordable? Well, there is a safe harbor that's provided, and a plan is affordable if the employee premium for employee-only coverage is not more than 9.5% of that employee's W-2 wages for the year. You know, to determine whether or not your plan meets the minimum standards, the plan must provide for essential benefits and provide a minimum value. And we're still getting guidance on what it means to be minimum value, but right now it's the notion that a plan is expected to cover at least 60% of the cost of benefits. So as I mentioned, the next slide, please. Exactly, this requirement applies to large employers. And a large employer is an employer that employed 50 or more full-time employees, including equivalents, in the prior calendar year. Now, keep in mind that the controlled group rules apply. So that means that employers that are connected through 80% or more ownership are treated as a single employer. And these are the same rules that determine your employee population for the non-discrimination testing of your 401k plan or your other qualified retirement plans. And also, a full-time employee is a common law employee who averages 30 or more hours per week, and you can rely on scheduled work times to identify full-time employees. Next slide, please. An employer is exempt if during the prior year they had more than 50 full-time employees plus equivalents for 120 days or less, and the reason that they were above the 50 full-time employee limit is because of the use of seasonal workers. Next slide, please. The important concept in this analysis is exactly what are hours of service. Well, we're given a break on this in that it's not the same definition that's used in your 401k plan because those rules actually favor employees. Instead, there are a couple of equivalencies or safe harbors that are available. So the first one is the days worked equivalency, whereby an employee, if he's credited with at least 1 hour in a day, he's then credited with 8 hours of service. The same concept applies on a weekly basis. So again, if an employee is credited with at least 1 hour during a week, then he's credited with 40 hours per week. So for your non-hourly employees, you can use different methods for different employee classifications, and you can change methods each calendar year. Next slide, please. So exactly what is the amount of the excise tax that's due each month? Well, it depends on why the excise tax is triggered. If there is no plan that's offered, then the tax equals 1/12 times $2,000, which will be indexed after 2014, times the total number of full-time employees that actually receive the premium or some sort of subsidy on the exchange. And then this number, though, is reduced by 30. So in this respect, your first 30 full-time employees are free because they're disregarded. On the other hand, if you do offer a plan, but it's either unaffordable or it does not meet minimum standards, then the penalty is going to be 1/12 times $3,000 times the number of full-time employees during that month that actually get their insurance from the exchange and that they receive either a premium tax credit or cost-sharing assistance. Now, this second calculation is not reduced by 30. Next slide, please. So exactly how do you know if you're going to be liable for this tax? You're going to get a notice. And right now, the current rules, which haven't been worked out, but the thought is it's the state exchange that's going to notify employers that they are liable for this excise tax. And it's on the shoulders of the state exchanges to determine an employee's eligibility for the premium tax credits or cost-sharing reductions and to determine whether or not your plan is affordable and whether or not it's adequate. After making these determinations, the exchange will then notify the employer and will give you a list of all of the affected employees. And finally, the notice is going to explain how the employer can actually appeal all of these determinations. Next slide, please. So why is this guidance, important? Well, it gives you a safe harbor to identify those workers who are not full-time employees. And this is important because if it's the employer's intent to cover all full-time employees, you need to identify which workers are full-time. And then secondly, if the employer wants to exclude certain full-time employees, then it would be a good heads up to determine what your possible liability under the excise tax would be. Then this calls into question exactly who is a variable hour employee. A variable employee is somebody who, as on the hire date, the facts and circumstances do not allow you to reasonably determine who is going to be a full-time employee, who's going to be able to work 30 hours per week. A seasonal employee is somebody who works on a seasonal basis, and this they still haven't given clear guidance, and they're actually requesting comments to help fill out this definition. But examples of a seasonal employee would be a retail clerk who's hired for the holidays, or a ski instructor who's hired by a ski resort to work only during the winter months. Next slide, please. One of the things that's helpful under this guidance is that they provide you some optional safe harbors to be able to identify who's your full-time employees and who's your part-time employees. And these safe harbors are based on the concepts of look-back periods or measurement periods to identify your full-time employees, and also stability periods. And stability periods are the periods of eligibility and coverage, and they immediately follow the end of a measurement period. Now, stability periods have to be at least 6 months long, and this 6-month requirement was put in place to prevent the constant migration of employees between employers' plan and the state exchanges. So what happens then is you identify those employees who during the look-back measurement period, and that can be anywhere from 3 to 12 months in length as selected by the employer, who averaged at least 30 hours per week. So those are your full-time employees. And I think what's curious about these rules or the safe harbor is that once an employee attains full-time status in the look-back or measurement period, then he has to be treated as a full-time employee for the following stability period, regardless of the number of hours he actually works during that stability period. Now, the flip side of this is also true. If the employee didn't make full-time employee status during the measurement period, then he will be deemed a part-time employee for the following stability period, regardless of the number of hours worked during that period. So next slide, please. So to illustrate this concept, I just want to review a quick example of this full-time employee safe harbor. And also this example uses an administrative period or an open enrollment period following the measurement period. And this example was provided specifically because the DOL, the HHS, they actually talked to a lot of employers to see how plans are run. And so they didn't want to create whole new procedures. And so they were hoping that this would be helpful. So in this example, the health plan is limited to full-time employees and their dependents. And the standard measurement period or look-back period is a 12-month period that begins every October 15th. And then the administrative period or the open enrollment period begins right after the end of the measurement period and then runs until the end of that calendar year or December 31st. Now, the stability period that's related to this measurement period is then the following calendar year. So in our example, we're looking at 2 employees, Adam and Bob, and they've worked continuously for several years. Now, Adam, during the measurement period, actually works a full-time schedule. But on the other hand, Bob works less than 30 hours, so he's a part-time employee. And so during this, in this example, Adam attains a full-time employee status, so he's going to be eligible for the plan for the calendar year 2014, even if during 2014 he works less than 30 hours per week. So he'll go through open enrollment in the fall of 2013, and then he'll enroll in his selected plan effective January 1st of 2014. Now, on the other hand, because during the measurement period, Bob did not attain full-time employee status, he's going to be ineligible for the entirety of 2014. And this is true even if Bob works more than 30 hours per week in 2014. Now, a plan may always be more generous, and it could offer coverage to Bob. But under this fact pattern in this example, the employer is not going to be liable for the excise tax. Next slide, please. The new rules also contemplate that employers can impose a wait period before their eligible employees actually join plans. And this wait period can be up to 90 days in length. And if you do use a waiting period, the excise tax is not going to apply. The next slide, please. There are lots of, while this guidance was helpful, I think, there's still lots of open-ended questions. And so the agencies have actually asked for comments on 4 specific things. One, first of all, what about safe harbors to determine the full-time status of different types of employees? For example, short-term assignment employees or temporary staffing employees, or those employees who are hired in a high turnover position. What kind of safe harbor would be helpful for employers? Also, would it be helpful to have additional guidance to be able to easily identify who are your full-time employees? Another big question is, what do you do in a merger and acquisition situation? Because it's very possible that the measurement periods, the stability periods are going to be different between the buyer and the acquired company. And finally, they would like some help on defining seasonal employees. Exactly who should that cover? Next slide, please. I think some of the things from this guidance right now, 2014 may seem a long ways away, but in some respects it's not very far away at all. But I think the first step employers should take is they should analyze their plans to determine, is it affordable and is it adequate? Now, if your corporate structure is fairly simple and your workforce is comprised mainly of full-time employees and you want to offer your plan to all full-time employees, then the excise tax is probably not going to be applicable. Also, keep in mind that plans can be more generous and they can cover part-time employees. I think what also these new rules require is that employers are going to have to start tracking hours of service for all employees from their hire date. And this could be a big change in administrative process for many employers. Also, plans that exclude certain classes of full-time employees, they risk the possibility of triggering the excise tax because if any of those full-time employees actually get their insurance from the exchange and qualify for some sort of subsidy, then the excise tax looms. Also, until further guidance is issued, denying eligibility to employees based on definitions that are not based on hours of service risks the excise tax, especially if an excluded employee can actually average more than 30 hours per week during a measurement period, and they do get a subsidy from the exchange. If you could run through the additional slides until we get to Sam and Andrew's. Oh, the rest of my slides I've just considered, or I just included for your reference only. These whole new analysis creates a lot of different definitions, and so I just sort of gave you more the exact definitions at the end of my slides, and so that's the purpose of that. But with this now, I'd like to be able to turn it over to Sam and Andrew.
Thanks, Kathy. This is Andrew Greger. I'm going to speak first here, and then Sam will take over. I'd like to talk to you today about a few of the upcoming requirements that are brought about by the Affordable Care Act. So let me see if I've got control of the slides here. I may. It looks like I don't. If somebody could hit a slide for me, that'd be great. Thank you very much. So the first requirement I want to talk about today, it's a relatively large one. It's the requirement to provide a summary of benefits and coverage for your group health plan. And you have to provide a summary of benefits and coverage for each benefit package that's offered. This is something that's required now for open enrollment this year, so in the next week or 2 or 3. So hopefully it's something that you already are aware of and have implemented. But it's worthwhile to keep in mind what you have to do this year. So the summary of benefits and coverage has to be provided to current participants who are re-enrolling to open enrollment and they must receive the summary of benefits and coverage for the benefit package in which they are currently enrolled. And that's for open enrollment 2013. Beginning January 1, open enrollment 2013. Beginning January 1, 2013, you'll also have to provide these SBCs to new hires, and they must receive SBCs for each benefit package in which they are eligible to participate. Benefit package includes, for example, here we have an HMO offering and a PPO offering, so new hires would receive an SBC for each of those two options. However, if in the case where dependents are eligible, and so you can have individual coverage and individual plus spouse and individual plus family, all those options, there's only one SBC that needs to be prepared and provided to the employees. And then SBCs must be provided to both participants and beneficiaries. However, if you don't know that the beneficiary lives in at a separate address, you can provide the SBC to just the participant, and that will cover the beneficiary. If you know the beneficiary to live at a separate address, you must provide it to the beneficiary separately. You also have to provide, in addition to providing the SBCs for the coverage in which the participant is eligible, you'll have to provide any SBC that they request within 7 days of that request. Also, COBRA qualified beneficiaries need to receive SBCs. The COBRA qualifying event doesn't trigger an SBC, but in open enrollment this year, those COBRA qualified beneficiaries that you have must receive SBCs just as regular participants or enrollees will receive. There's a penalty, a potentially stiff penalty, for not providing SBCs of up to $1,000 per failure. So that's per employee that doesn't receive SBC. However, this year there's good faith allowance that the agencies aren't going to be enforcing that penalty very strictly. They're going to allow good faith compliance. And can I get a slide, please? Thank you very much. Another requirement coming in from the Affordable Care Act this year is the requirement to report the aggregate cost of applicable sponsored coverage on W-2s. And this is required for the 2012 W-2, which is, as you know, issued in January 2013. I think that the biggest thing to remember on this is that this is merely informational. The reporting of the aggregate cost of group health plan coverage does not change the taxability of the coverage, and doesn't change the amounts in box 1 or box 2 of the W-2, but just it goes in box 12 under code DD. I happen to do some pro bono work on the side where I interact with, do tax returns for individuals, and I find that generally because this was an optional element to add to W-2s last year, and a lot of people had it on their W-2s, and they didn't get too excited about it. That said, I think it's very important to make sure that your HR team is aware of this addition to the W-2 and prepared to answer questions that will arise about this amount. I think the amount is probably going to be considerably higher than a lot of employees would expect. So I think informing your HR team is valuable. Plus, you want to make sure that your payroll department is aware of this new requirement and that they're getting the aggregate cost amount in time to be able to add it to the W-2 that goes out in January. Slide, please. Thank you. The two other requirements that take effect with 2013. One, health flexible spending accounts now have an annual employer salary reduction contribution limit of $2,500. So this is something you need to make sure is in your enrollment materials this year for the 2013 plan year. And you'll need to make an amendment to your cafeteria plan documents. However, that amendment isn't required actually until the end of 2014, so there is time on that. This requirement does not apply to certain employer contributions, so employer matching contributions and flex credits. However, if the employer contribution is one that an employee can elect to receive as cash, that does apply to the $2,500 limit. And the final Affordable Care Act issue that kicks in this year is for the coverage of women's preventive services. And this kicked in actually for plan years that begin on or after August 1, 2012. For calendar years, it's a January 1, 2013 requirement. By way of background, the Affordable Care Act instituted a requirement to provide coverage, first dollar coverage for preventive health services. And first dollar coverage here is coverage that doesn't impose any co-payments, co-insurance, deductibles, or cost-sharing requirements. You have to cover it from the first dollar. And one of these preventive health services that was required to be covered is certain women's preventive services as provided in guidelines by the Department of Health and Human Services. They released the guidelines and they kicked in as of August 1 for the next plan that begins. There is a very narrow exception for religious employers that they don't have to cover contraceptives if they fit into this very narrow exception. And then there's a 1-year safe harbor grace period for a broader spectrum of nonprofit employers who currently choose to not cover contraceptives based on their religious beliefs. That only apply in a few limited situations, but it is something that's available. And for the women's preventive services, you're going to want to make sure you contact your TPA and insurers to ensure that they are ready for the new preventive health services, and also issue a summary of material modifications describing the additional preventive health services that are going to be covered under your plan. Additionally, this needs to be covered in your summary of benefits and coverage. We've worked on preparing some. It's not an issue that's going to come up that's going to be covered heavily in the SBC, but it needs to be addressed. With that, I'm going to hand it over to Sam, and he's going to talk about a few more 2012 action item issues.
Thank you, Andrew. Just as an overview, Andrew and I, what we're doing, this is something that we've done in our webinars for the last couple of years, are giving you an overview of what you need to do before the end of the year for your welfare and your retirement and your non-qualified deferred compensation plans. So you can start thinking about it now that you have 2 months, a little over 2 months left, and don't have to run around looking for signatures between Christmas and New Year's. So Andrew has covered the things that if you haven't already taken care of, you should be taking care of before the end of the year in your welfare plans. And so now moving to the retirement. The first item, which is this slide 36, talks about Code Section 436. And what this is that the Pension Protection Act in 2006 imposed a number of restrictions on defined benefit or traditional pension plans, intending to shore up their funded status or their funding. And one of the things that they put in was that if you've got a defined benefit plan and its funding level drops below a certain amount, in this case there's called a funding target attainment percentage, drops below 80%, then you're not allowed to make certain kinds of distributions. Generally, the most common effect is you can't make lump sum distributions. And so I know a lot of you have been looking at your plans with your actuaries, if you have defined benefit plans, to make sure that you keep if you have a plan that provides lump sum distributions, that you keep your funding above that 80% level. There are also other limits on additional accruals or increased accruals at various funding levels. But the purpose of this slide is not so much to remind you about those requirements, because they in fact have been in effect since the first plan year starting on or after January 1 of 2008, so presumably you've been complying with them. But is to remind you that this is a plan document amendment, a technical requirement. You're supposed to have the document provisions that reflect these Code Section 436 requirements in place by the end of this year. Now, initially, the IRS had set an earlier date to be the deadline for adding the Code Section 436 funding limitations to your defined benefit plan. And many plans, the clients that we've been working with all had language that we crafted ourselves based on the statute. Congress passed a statute, but the IRS had not issued any model language by the time the first deadline passed. But now the IRS has come out with some model language, and they also late last year they came out with this model language. They also extended the date by which you could make the amendment to add these Code Section 436 provisions. So this is a two-step analysis for you in your year-end planning. One is make sure that you have some 436 language in your plan document, and if you don't, you need to get it in there by whatever procedure you amend your plan before the end of the year. And then second, if you've already put Code Section 436 language in your plan and it's different than the IRS's safe harbor language, we suggest that you think about replacing the language that you have in your plan with the safe harbor language. Reason being, it's never a bad idea if the IRS comes out with language that's guaranteed to be kosher and it doesn't give you too much heartburn. It's always a good idea to use their language. So that is a second item that you should look at, and of course if you decide you want to replace it, you should do that by the end of this year. Next slide, please. So the next item that we want to talk about with respect to pensions or retirement plans, and this is switching to defined contribution plans, is the fee disclosure requirements. Now, this year, the Department of Labor had us, and all sponsors of defined contribution plans, begin a new disclosure process regarding fees that are assessed in 401A, that would include 401K plans, and 403B plans. And so where the participant has generally is where the participant has self-direction, and we're telling them about the fees that they're going to be charged. Now, the theory of all this was that ERISA imposes a fiduciary duty on plan fiduciaries to plan sponsors to prudently select investment options and to make sure that the expenses and fees that are being paid are reasonable, and even more basically, to know the fees and expenses that are being charged, something that a lot of plan sponsors unfortunately didn't know. So the point of this process was to compel the employers to look at what the fees were, get educated about them, and then pass notice on to the participants. With respect to the vendors, it was that the vendors had to start disclosing the fees because quite frequently they would hide the ball on the fees, and so it was the employers had a hard time knowing what they were. So the Department of Labor came up with some disclosures that they wanted the vendors to provide, and the vendors had to get those to employers by July 1 of this year, which presumably has happened. If it didn't, you were supposed to go to the vendor and ask for the information using certain procedures. And then by August 30, the plan sponsors, presumably you listening, were supposed to get fee disclosure notices using Department of Labor blessed format out to the participants. And presumably you've already done that. If you haven't, this is something you should work on. But the purpose of this item in today's discussion is to tell you about the next phase of this, which is on November 14th, the first quarterly statements are due, and the quarterly statements, unlike the annual statements, which show general plan fee information, things such as the basis point charge for various mutual funds in the plan. This particular quarterly disclosure is supposed to show the fees and expenses that were actually deducted from the participant or beneficiary's account. And this would include things like administrative expenses, a description of how revenue sharing works to pay some of the general administrative expenses. If there is a per capita administrative fee that's taken out of a participant's account, to show them what exactly was taken out of their account, and then individual expenses showing the dollar amount. And this would be for things like a quadro qualified domestic relations order, processing fee, a loan fee, those sorts of things. And so this is due November 14th, just 3 weeks from now. And so this is something that if you haven't already been doing so, you should be working with your vendor or rattling their cage to get them to provide you with these statements, or to help you prepare one so that you can get them out to participants by November 14th. Next slide, please. The last item that you should be concerning yourself with, this has to do with non-qualified deferred compensation, and most particularly with severance pay arrangements. This arises under Internal Revenue Code Section 409 Cap A. This was added after the Enron implosion, and Congress was concerned that executives might try to pilfer company funds if they knew it was going down before others got wind of it for their non-qualified deferred comp or just for their own interest. So they put some restrictions in to prevent any sort of tampering with the timing of payment in non-qualified deferred compensation. So the IRS then took a few pages of statute and came out with 160 plus pages of regulations implementing this, and they're quite intricate. But one of the things that they did as part of their continuing enforcement and exposition of this statute and their regulations is that they came out in 2010 and said that a clause or type of clause that's very common in severance agreements, employment agreements with severance provisions, is potentially a violation of 409 Cap A, and that is a clause that says that you get your severance pay only if you sign a release, or only after you sign a release. And if there's an age discrimination piece of the release, only after you've allowed the statutory revocation period that has passed without you revoking the release. So the IRS came out in this 2010 notice and said, well, we think that gives executives an opportunity to time when they get their money by delaying the execution of the release. They can pick which tax year oftentimes they want to take their severance pay, and we think that's a violation of 409 Cap A. So they basically came out and said that if you just have a plain provision, which is almost universal in my experience, that would violate 409 Cap A. So you have to fix it. You either have to pick a set time after termination when the payment would be made, say 60 or 90 days, and before that time happens, the employee would have had to sign the release and let the revocation period pass, and then that set day would be the payment date. And then after a lot of hue and cry from the legal and compensation consulting community and employers, they came out with a subsequent notice in late 2010 and said, okay, there's a second way you can do this, which is you could specify a period of time by which the payment would be made, and that is to say within that time the release would have to be executed, but that if that period of time straddles 2 tax years, it always has to be paid in the second tax year. Again, so there would be no timing. Now, the purpose of our notice and slide here is not so much to educate you about this, just to remind you about it, because this happened in 2010, but to say that the IRS said that if you had agreements that were or plans that were violative of this principle, you could correct them in writing by the end of this year. So we wanted to remind you that as a takeaway from this, that you should look at your existing executive employment agreements or severance agreements or programs, and if you've got release requirements, make sure that they've been adjusted to be compliant with this IRS guidance. There's also, which I won't go into in great detail, there's also the possibility that if you've paid money out this year under an agreement that you've already paid it out in violation of this rule, or under an agreement that violates this rule, that you can also correct it using some correction procedures. But that also needs to be done by the end of the year. So with that, those are the things that we would recommend that you make a checklist on the welfare plan items that Andrew has touched on, and the retirement and non-qualified deferred compensation items that I've touched on. Make that list and do it this week, and make sure that you've done all those things or put a game plan in place to have them completed by the end of the year. With that, I thank you for listening.
Thank you, Sam. This wraps up today's Employee Benefits broadcast. We invite you to contact any of today's speakers if you have additional questions or if you'd like additional information on their particular topics. As a reminder,